where you are essentially selling puts to go out and buy calls. This is a very effective strategy if you are incredibly bullish on the stock. However, it does open yourself up to a lot of risk, and I am seeing this trade happen at an increasing level. So I want to talk about it because there is a lot of potential utilizing this trade. However, it can be somewhat worrisome as well. The stock that I want to use for this is AMD because it has recently had quite a bit of volatility, as you can see over the past 3 days, and there's still a lot of potential with the stock as well. Again, I'm long AMD just for full disclosure. And if you like videos like this where we cover options trading and stocks with pretty in-depth coverage, feel free to leave a like on this video or subscribe. So what I want to talk about with AMD is this idea of how you can utilize options to build up a leveraged position. So the first thing that you want to do in a position like this is you're selecting your options date. And for those of you who are wondering, I am utilizing the Thinkorswim web application through TD Ameritrade. What I'm going to look at here is the May 28th date. This is going to cover earnings because AMD does announce earnings at the end of April. What you're going to do is you're actually going to sell a put. So what this is doing right now is this is saying that I have the option to sell, or someone is taking this option to sell their shares to me at $82.50 a share. What they're going to do is they're going to pay me $470 or $4.70 for each share in a block of 100 shares, and then I would have to buy their shares at $82.50. What I'm going to do for this example is I'm actually going to set it at $80 a share. So what this would require from me is I would be getting paid $340 for each one of these contracts. So because I've got 10 contracts here, tell you what, we'll do one. Because I have a contract here, then I would have to hold in collateral $8,000. So you can see here that we've got our buying power effect is being taken down because you're going to have to utilize that collateral value of $8,000. Now, what I want to focus on here, though, is what we are doing with that money, or what the next step of that was, because that's what we're increasingly seeing more of is, hey, because you are making $340, what can I do with that $340? And if I'm incredibly bullish on AMD, what's actually happening here is people are then going out, and so you have that May 28th, they're then buying a call. So we'll go pretty close to the money right here, where because I'm getting paid $370, this option is only going to cost me $73 because I'm just taking the proceeds from selling the put, and now I can go and put that into buying the call. So what does this set you up? Well, if the stock really doesn't move too much and it stays between that $80 and $83, you don't lose anything. However, this is pretty great because if it goes to the right-hand side of your screen, you can see right here that if the stock goes up to $87, $88 a share, you can make a decent amount of money. I would further emphasize this capability by, again, if you make these numbers a little bit more material, where I'm still paying now $730, that's my max risk if this stays in the range. However, I can make a lot of money if the stock goes up to, let's say, $90 a share. I've made $6,000. So this is very popular right now, and a lot of people are selling these puts so that they can go out and buy calls. The issue is, as you can see, because stocks have continuously gone up and up and up. So I'll do the year mark for AMD just so that we can take a look at that on an annual basis. You can see that they traded low and then they have stayed up ever since then, since about 8 months ago. So as the stock market has continued to be on a bullish run, people have continued to sell puts to buy calls. The issue with this strategy is if the stock goes down, if you have a time period where it goes from 90 to 80, you can see that that $5 move here, if we go down to simply $75 a share, you end up losing a lot of that leverage collateral. In this scenario, it would be losing $5,600. So right now the stock's at $82. If it goes up to $87, you gain 3,700. If it does a $5 move the other direction, then you have a $5,000 loss. My concern here is what happens if the stock makes a bigger move. You can see those numbers get very, very material very, very fast. The reason that I emphasize this strategy and highlight it is, yes, there's a lot of potential for it, but also you are putting a lot of risk up there. If you optimize or if you opt for this strategy, my suggestion is that as the stock moves or does not move, just because your contract is going down in value from a call perspective, if the option kind of stays in, or if your price stays in this type of range, that sometimes it's worthwhile to buy back those puts. So these puts, if you go back to just looking here, you're going to be getting paid $340 per put. Because of that, that means that over time, if the stock doesn't move too much, the options premium here is going to devalue. And if it gets down to $200 to $180 in value, it can be very beneficial for you to then buy that back and release that collateral. At the $80 mark, that's $8,000 per options contract that you're getting paid for. So this is just a strategy that you can potentially utilize, but I do want to make sure that those of you out there are aware of the risk as well. So if you want more of this content, feel free to subscribe, or if you want to ask questions about it, drop that in the comments down below, or feel free to join the Discord. I appreciate it. Thanks, and talk to you later.